All right, welcome to this explainer. We're jumping right into a massive problem in modern finance today. Why chasing isolated AI trading signals is literally destroying portfolios. More importantly, we're going to break down how you can build a resilient, human-managed framework instead. Let's get right into it. So picture this. You wake up, grab your phone, and by 10 a.m., you've got 5 automated buy alerts flashing from your AI models. You feel great about it, right? So you enter a leveraged position. But by noon, boom, you're completely liquidated. Now here's the kicker. What failed that morning wasn't necessarily the signals. They were just doing their job. What completely failed was the total absence of a structured framework around those signals. Today, we're shifting your mindset from the absolute chaos of signal chasing to the clinical discipline of frameworks. We'll cover 6 key areas: the trap of automation bias, signals versus trading frameworks, the reality of probabilities, opening the black box, the 5-step trading framework, and finally, human judgment and risk. Okay, starting with Section 1, the trap of automation bias. There is a deeply rooted psychological vulnerability that plagues so many retail traders, especially those hunting for absolute certainty in volatile markets. It's a behavioral phenomenon called automation bias. Basically, when we rely heavily on automated systems, we experience something psychologists call cognitive offloading. You essentially strip away your own critical thinking. You stop actively analyzing the environment, and instead you devolve into this vulnerable, passive follower. You end up blindly trusting an algorithm, even when macro conditions are screaming at you that the market regime has entirely changed. And if you want to understand the truly catastrophic consequences of this cognitive offloading, you just need to look at the 2012 Knight Capital incident. Due to unchecked automated execution, meaning they had no independent human-in-the-loop kill switch, the firm suffered a staggering $440 million loss. And that happened in just 45 minutes. Blind trust in a black box system isn't just flawed, it's incredibly dangerous. That brings us to Section 2, signals versus trading frameworks. We really need to grasp the vast difference between an isolated alert and a complete trading architecture. A signal is just an isolated, context-free trigger. It says buy or model says UP. That's it. It has zero concept of risk. A framework, on the other hand, is your complete decision loop. It defines your macro context, your hypothesis, your time horizon, your strict risk caps, and exactly how you review the trade afterward. You can think of a signal as raw, unrefined material, while the framework is the intelligent, structured manufacturing process that dictates exactly how, when, and with what risk you deploy that material. The industry consensus on this is crystal clear. Renowned trading coach Van K. Tharp actually pointed out that the discrete entry signal accounts for less than 10% of a complete trading system. Think about that. The remaining 90% relies entirely on human psychology, position sizing, risk management, and structural discipline. So if you're spending all your time hunting for the perfect signal, you are literally ignoring 90% of what keeps you in the game. Moving right along to Section 3, the reality of probabilities. To build that structural discipline, we have to fundamentally shift our mindset. We need to stop seeking guaranteed profits and start managing mathematical probabilities. See, traditional deep learning models are frequently miscalibrated. They act way too confident. But a properly calibrated probabilistic forecast, like one showing a 60% confidence score, inherently and explicitly acknowledges a 40% probability of failure. And you know what? You have to frame that statistical uncertainty as a vital feature of your risk management, not a bug. It forces you to accept that you're managing a distribution of outcomes, not staring into a crystal ball. Real-world tracking proves this point exactly. Peer-reviewed research on crypto machine learning forecasting shows that honest directional accuracy actually sits in the low to mid-50s. Take OneStrat's conservative Bitcoin model, for example. It reports a 54.3% accuracy. That is a realistic edge. An actual edge comes from exploiting those probability distributions over a huge sample size with strict risk controls. It absolutely does not come from betting your whole portfolio on a single isolated prediction. Let's dive into Section 4, opening the black box. Even when you have properly calibrated probabilities, relying on opaque deep learning models creates a really dangerous trust deficit, especially in high-stakes environments. We solve this by using Explainable AI, or XAI. Basically, this transparency layer replaces the black box with a glass box. Methodologies like SHAP, which is Shapley Additive Explanations, and explainable boosting machines let operators actually look inside the model. Rather than just giving you a direction, XAI exposes the specific, localized market drivers behind a forecast. This is a game changer because it empowers you, the human trader, to audit the model's logic and make sure it aligns with your own read of the macro context. So, what does this transparency actually look like? Well, a clean, explainable AI forecast card structures the data logically. You'll clearly hear what the asset is, the specific time horizon, like 4 hours, for instance, the statistical confidence, and crucially, the underlying bullish or bearish drivers. If the model says Bitcoin is going up because funding rates are positive, but you know a major interest rate decision is dropping in 10 minutes that the model can't foresee, well, now you can intelligently override it. This takes us to Section 5, the 5-step trading framework. Here's how we turn all this transparency into a highly actionable workflow where AI acts purely as a decision support tool. It flows linearly. Step 1 is context. You define the macro environment yourself. Step 2 is forecast. You check the AI's calibrated probability. Step 3 is explanation. You audit those XAI drivers we just talked about. Step 4 is the decision filter. This is where you apply your strict personal risk and sizing rules. And finally, Step 5 is review. You journal the outcome to build a continuous feedback loop. Now notice a really vital detail here. The AI model is only consulted in Steps 2 and 3. The entire surrounding architecture, reading the market regime beforehand, setting strict invalidation levels, deciding how much capital to risk, and doing your post-trade analysis, that remains 100% in your hands. The AI supports the framework, it does not replace it. Which brings us to our final section, Section 6, Human Judgment and Risk. This is the ultimate, sober reality of algorithmic execution. Human risk management is absolutely necessary because unpredictable structural shocks will always happen. Take the massive crypto leverage cascade in October 2025, for example. Over $19 billion in leverage was liquidated in roughly a single day, and top-of-book depth shrank by more than 90%. Black swan events like that prove that even if your AI model is perfectly directionally accurate, it is entirely useless against systemic market gaps if your position sizing is wrong or your leverage is too high. We really have to respect the limitations of artificial intelligence here. AI cannot mathematically manage your risk. It cannot dictate your fractional position sizing. It definitely cannot calculate theoretical models like the Kelly criterion for your specific portfolio. And it absolutely cannot protect you against unprecedented black swan events. Listen, a 54% accurate model paired with excessive leverage and terrible invalidation discipline is going to destroy your portfolio faster than a coin flip. Human execution discipline is the foundation that keeps you alive. As we wrap up this explainer, I want you to keep this core thesis in mind. Integrating AI into finance is not about finding some magic crystal ball that guarantees profits. It's about building a highly accountable, probabilistic research process. Clearer frameworks will always outperform louder signals. And just a quick note, please be aware that this explainer is strictly educational and does not constitute financial advice. AI forecasts are inherently uncertain. You must maintain sovereign, human-in-the-loop authority over your capital and risk management at all times. So the final question you really need to ask yourself is this. Are you going to continue chasing the dangerous illusion of the perfect signal, or are you ready to do the real work and build the clinical framework required to actually survive the market?